Welcome to Race and the Internal Revenue Code, sponsored by the ABA section of Taxation. If you are seeking CLE credit, you must attend the entire program. Partial credit is not available. Please click on all participation verification alerts during the program to confirm your attendance. Immediately after the program ends, a link to complete the certification process will appear. Please complete the evaluation and the CLE affidavit, providing your bar information as requested. Once the completed form is submitted and your attendance verified, your certificates will be emailed to you. Moderating the program today is Omeed Firouzi. Omeed, you may proceed with the program.
Thank you so much. My name is Omeed Firouzi. I'm an attorney at Philadelphia Legal Assistance Low-Income Taxpayer Clinic. I'm currently an American Bar Association Section of Taxation Christine A. Brunswick Public Service Fellow. And today I'm honored to be introducing the rest of today's panel on race and the Internal Revenue Code. Joining us today are Jeremy Beerer-Friend, Aravand Budapalli, Karen Brown, and Kim Rubin. Jeremy is an associate professor of law at the George Washington University School of Law. Aravand Budapalli is a research analyst at the Urban Brookings Tax Policy Center. Karen Brown is Theodore Reinhardt Professor of Business Law at the George Washington University School of Law. And by the way, I'm a GW undergrad alum, so I'm honored that they're here. And Kim S. Rubin, Sol Price Fellow and Director of the State and Local Finance Initiative at the Urban Brookings Tax Policy Center. So I am privileged that they are all here today, and I thank them all for this opportunity. We are now going to begin the panel. And in fact, I wanted to talk about how the reason we're having this panel is that this country right now is focused on the many racial inequities that permeate our society. And one area in which they are present as well is the federal tax code, as well as state and local taxes and international taxation. All of these taxes impact racial inequality in different ways. And our panelists are going to be discussing those ways in which they relate to racial disparities today. And in fact, this panel features a demonstration of a recently released interactive feature that traces the IRS Form 1040 line by line to examine the impact of the federal tax code on racial and economic inequality. This panel will further explore the impact of colorblind tax data on social policy, and panelists will also discuss the racial inequities perpetuated through taxable treatment of employment discrimination damages and how race intersects with international tax law and policy. So we're very excited about this. This is a very timely panel, of course, and we will have plenty of time at the end for questions from audience members. So with no further ado, I will first hand it off here to Kim and Aravand to discuss their recent study.
All right. I hope everyone can hear me. Good afternoon, everyone. Thank you to the ABA and for everyone who took some time from your Friday to join us. Kim and I are from the Tax Policy Center, and we're really excited to show you more about our interactive feature on the racial disparities in the income tax system. But before doing that, a little bit of a foundation on why we studied this topic, why racial disparities, why the income tax system, and why all of this matters. So with no further ado, let's start with the fact that the IRS does not ask you for your race or ethnicity when you file your taxes. And neither do new tax policies as we discuss new tax deductions or credits or changes. They don't typically talk about which racial group would benefit or not. And this makes it appear as if the tax system is neutral, equal, and objective in every way. We know, though, that the income tax provisions that we see are specific policy choices. They come with their own sets of motivations and disparate impacts. When you think about a new policy, you got to think about who gets to access it, who is eligible for it, who gets to benefit from it more than others, or who's burdened more by it than others. And the income tax system, like everything else, exists in a world of structural racism. And we define structural racism or systemic racism as a system in which government policies, social practices, cultural representations, as well as other norms work in ways to perpetuate racial inequities. And deep racial inequities exist today and historically in areas of education, employment, housing, the criminal justice system, particularly for Black and Hispanic households. And this is not something that someone chooses to practice, but it's a feature of our social, economic, and political world. And the income tax system intersects with all of this and can make racial inequities better or worse. Michelle Alexander, in her book, The New Jim Crow, talks about how our understanding of racism too often is shaped by individual discrimination or bigotry, not so much by the ways in which it functions naturally and visibly in a systemic way, and we have to think more about that. And I have to acknowledge that this area of research is not new. Critical tax theory in tax law scholarship has existed for decades and has talked about the impacts of tax law, how they originate, and how they traditionally marginalize some groups more than others. Professor Beverly Moran at Vanderbilt, Professor Dorothy Brown at Emory, and Professor Karen Brown at GW, who we'll hear from in this panel, have produced very important and influential work on these topics for decades, and we are very grateful that they've set a foundation for us to also talk about these issues. Before we get to the actual feature, a little bit more about the income tax system. So income taxes are about 50%, about half of federal revenues, and in fiscal year 2019, that was $1.7 trillion. And overall, the distribution of individual income tax is progressive. Low-income households pay a lower average effective tax rate than high-income households, and this implicitly means that the federal individual income tax system helps reduce income inequalities. The median income for Asian and white households is significantly higher than for Black and Hispanic households, and compared to their share of the population, Black and Hispanic households are less likely to be among the highest income taxpayers. And the highest income taxpayers pay the majority of individual income taxes under current law. But across the income distribution, taxpayers pay different amounts based on their sources of income and based on tax-preferred actions they've taken. And those actions can be within the world of retirement savings, healthcare, capital gains, whether they have children and dependents, what kind of housing or home ownership situation they're in. And so we arrive at that $1.7 trillion number after taking into account all of those tax expenditures, the graduated tax rate system, credits, deductions, exemptions for specific things. And those specific things can be for things like home ownership, can be for retirement saving accounts like Roth IRAs or 401ks. They can be for children and dependents. The EITC and the child tax credit are examples of that. They're for charitable donations, the deduction for charitable contributions, as well as for renewable energy credits that already exist in our tax expenditures. So when you look at those tax subsidies, you have to think about who benefits or who gets to access those tax subsidies that reduce your eventual average effective tax rate. So keeping all of that in mind, let's talk a little more about the interactive feature that Omeed introduced. So this is a little bit about the structure of our interactive feature. We provide a little bit of an introduction on the topic, and then on the left side, we go through line by line on the 1040 form, which is the U.S. individual income tax return for 2019, and the accompanying schedules 1, 3, A, C, and E. And we sort of build the structure where you can see those lines on one side, and on the other side, you can see what do they have to do with race, or what do they relate to largely, whether it be about age, whether it be about income, salary and wages, social security benefits, retirement savings. We put those into buckets. So when a user clicks on one of these items on the left, it opens a relevant category or bucket where they can see what this has to do with race. So for example, if one can see the filings, if one clicks on the filing status box, the marital status box will open on the right, and we'll talk a little bit about how tax liabilities depend on a taxpayer's marital status, such that dual earner couples with similar incomes can face a marriage penalty, while dual earner couples with very different incomes can get a marriage bonus, paying less in taxes when they file jointly as opposed to when they file single. But many more couples receive marriage bonuses under current law, and the share of households that are married varies widely by race, and the overall marriage rate has declined in the U.S. over the past 50 years, especially for Black households. Professor Dorothy Brown at Emory University has discussed this issue extensively, and so has Professor Sandy Darity at Duke University in discussing how wealth inequalities shape family structures and not the other way around. Another example of this is capital gains. So unlike taxes on salary and wages, which are generally withheld as earned and must be paid annually, taxes on capital gains can be deferred by not selling the asset, and assets held for more than a year before gains are realized can get preferential tax rates. So these tax preferences cost the federal government hundreds of billions of dollars each year, and they primarily benefit the highest income taxpayers, therefore widening wealth disparities between white and Black and Hispanic households. And it is important to note here that racial disparities that we talk about here are not due to individual behavior, but rather a result of structural racism. Factors like wage disparities, labor market discrimination, lack of access to financial capital all shape who gets to access and benefit from tax subsidies. So here's an example of what happens when you click on line 4A or line 4C, which are retirement savings lines. So if you open that one, we give a little bit of a description of why retirement savings have something to do with racial disparities, and we'll talk a little more about the content of this in a few slides. So here we have a GIF slide, which does not work, but we do have a link to the feature at the end, and we hope everyone gets a chance to actually go to the link. At the end of the feature, we also have more data, more discussion about what data sources we use. A lot of our racial disparities data is from census and the Survey of Consumer Finances by the Federal Reserve Board. So you can get more technical information at the end of the feature. So let's get into the retirement savings bucket. We talk a little bit at the start about why retirement savings get tax preferences. And that's because contributions to traditional 401k or IRA plans can be on a pre-tax basis. Taxpayers get to defer all taxes on those contributions and earnings until they withdraw the money in retirement, at which point it is taxed as ordinary income, but typically at lower average rates than they would have paid earlier. With Roth IRAs and Roth 401ks, the tax treatment is reversed. Contributions are taxed, but neither the growth in the assets nor the withdrawals made in retirement are subject to tax. And this matters because in 2016, 60% of white families held retirement accounts compared with 34% of Black families and 30% of Hispanic families. So when you have disparate access to retirement plans from workplaces, you see a growing disparity for families holding assets. The white to Black and white to Hispanic ratio in the value of retirement accounts has grown from twice as high to 3 times as high in the last few decades. So the federal government subsidizes tax preferences for retirement savings. Retirement accounts comprise a large share of wealth for American families, and therefore the tax subsidies for retirement savings are not helping those who may need them the most, which is Black and Hispanic households. A different example that we also talk about in the feature is the Earned Income Tax Credit, which is the refundable income credit primarily for low and moderate income working parents. And that costs about $300 billion over a 4-year period between 2019 and 2022. And white households are the largest share of EITC recipients because they're the largest share of the working population. But women of color are disproportionately likely to benefit from the EITC because of occupational and wage disparities and because they typically have lower incomes and are slightly more likely to have children. So the EITC has been praised a lot by a lot of tax professionals for being a very effective anti-poverty measure that helps reduce racial income inequalities. However, in recent years, we've learned more and more about how the EITC returns are audited at higher rates than a lot of individual income tax returns. And over time, the IRS's budget and full-time staff has fallen, which has led to lower audit rates for everyone, but the audit rates for wealthy taxpayers have fallen more sharply than they have for EITC returns. So when you look at how the IRS directs its existing enforcement resources and how it chooses to prioritize certain audits more than others, you can see how audits can disproportionately hurt Black and Hispanic taxpayers more. And with that, I'll pass the mic to my colleague, Kim Rubin.
Thank you. And I even remembered to unmute my phone. Thanks for having us. We're super excited to share the tool, and partly this is one of our initial efforts. Okay, why can't I get the slides to move? Okay, excellent. This is an initial effort of some work we're doing at the Tax Policy Center, trying to disentangle some of these effects and think about how, even though the IRS doesn't ask for questions about race, which Jeremy is going to talk more about, there are different effects, and different policies that are embedded in the tax code can have differential effects on different households because of their characteristics and some of the history of how things became part of our tax system in the first place. So Arvind had talked about one of the benefits that is actually helpful and might lower income disparities between Blacks and Hispanics and white populations. But a lot of what we see in the tax code and that we talk about in this interactive are things that primarily benefit higher income households. So one of them is, if you think about housing and home ownership. Right now, we have a deduction for mortgage interest and the exclusion of some realized capital gains from home sales. So the mortgage interest deduction is a way that we're trying to encourage people to own homes. Well, at first, if you look at sort of who owns homes, we can see that Blacks and Hispanics are much less likely to own their homes, so they're not going to get access to this credit. While this deduction costs about $280 billion over a 3-year period, it doesn't actually necessarily do what policymakers have said they are hoping to do, which is mainly to increase home ownership. And so there have been numerous studies that have actually shown that the prevalence of home ownership isn't increased by having the mortgage interest deduction. What seems to be happening is we're encouraging people to buy bigger houses and take on more debt. And so you could imagine a different public policy that we do through the tax code, namely something like our first-time home buyer's credit, that could not only achieve this goal as it is laid out as to why we actually are trying to encourage do things in our tax system, but also would have very different impacts. If we actually focus this on new home buyers, it would actually probably benefit Black and Hispanic households more than it does right now, and would also benefit them more. This is actually incredibly important if we think about the fact that Black and Hispanic families are also those that are likely to spend a huge percentage of their income on rent or housing costs. And so we could actually have policies in our tax system that have differential effects than what we currently see right now. Partly, who benefits from the mortgage interest deduction and the other itemized deductions, and we go through the state and local deduction and charitable giving as well, changed a lot with the passage of the Tax Cuts and Jobs Act in 2017. So after 2017 and the passage of the Tax Cuts and Jobs Act, one of the things that happened is the share of households that were actually itemizing rather than taking the standard deduction dropped. So we went from about a third of households itemizing to about 11%. And what that means is even of those people who own houses and have mortgage interest that they might want to deduct, if they're not itemizing, they're not going to benefit from this deduction. And so what we've done in the TCJA is we've actually moved a lot of the benefits up in the income distribution, and we've also made it much more likely that the only people who are going to benefit from those itemized deductions are households that are earning more than $150,000 or in the top quintile or the top 20% of taxpayers. And so what we find is that 65% of people who itemize are in the top 20% of taxpayers, and they're disproportionately white taxpayers. So while overall 14% of households are Hispanic and 13% are Black, only 8% of households that earn more than $150,000 are Hispanic, and only 6% are Black. And so they're much less likely to itemize. And so while we can't say specifically who is itemizing and who is not, we do know that sort of just from the trends and from who are in those different income buckets, Black and Hispanic families are much less likely to benefit from the mortgage interest deduction and some of the other itemized deductions. And so the other thing that we sort of want to cover is what we're talking about largely today has to do with the 1040. But there's a lot more to tax policy and to taxes people pay. And so as Arvind pointed out at the beginning, so what we're showing here is other taxes and fees and charges over time. And basically, federal income taxes make up about 50% of the money that comes into the federal government. And about the other place where we're paying a lot in taxes are payroll taxes, or taxes that go for Social Security. Those taxes are typically on wage income, and they're paid more by lower income families because there is an income cap on that. And so, especially for Black and Hispanic households, they're often paying more in their payroll taxes than they're paying in their income taxes, where they're actually getting more money back from the federal government. Beyond who's paying taxes, something else that's really important to keep in mind is how are we spending that money? And so it's important to know that 2/3 of funding from federal taxes go to mandatory spending, while 1/3 go to discretionary spending. And a lot of what we're spending, so things like paying for things like Social Security and Medicare, actually do benefit lower income households, including Black and Hispanic households, although they're getting less of a benefit because they tend to be younger, and so they're not necessarily on Social Security. So for Black and Hispanic families or individuals who are over 65, Social Security is a huge benefit and is the large way that they're paying for their retirement right now. But it makes up a small part of the amount of money that they're getting because they're making up a smaller share of the people benefiting because they're a smaller share of the population. If we go over to the other side in the discretionary spending that's going on, a lot of it goes to defense. And then a lot of those other programs that are a small part of the federal budget are often those programs that we think of as helping lower income families or families of color. If we think about federal money that goes to Title I or to programs in education, they're a small part of the budget, and often they're the things that we're talking about possibly cutting. The other thing that's missing if we're looking at the 1040 is everything that's going on with state and local government. So a lot of what we do in terms of providing a social safety net are actually services that state and local governments are paying. And they also have a very different set of revenues that they rely on. And so the first bar shows where the federal government is getting its money. And as Arvind mentioned, personal income taxes are fairly progressive. So higher income people are paying a fair amount of these taxes, and they're also relying on payroll taxes. On the other side, state and local governments are still reliant in part on individual income taxes, but they make up a much smaller part of their revenue stream, and they tend to be flatter and less progressive. At the same time, sales taxes that make up a fairly large part of how state and local governments raise money are much more regressive, or we have lower income families paying a larger share of their wages or income in these kinds of taxes. So if we just look at what the federal government is doing, it actually makes taxes look much more progressive. And so partly it's important to at least keep in mind the fact that there's more to think about, especially what's going on with state and local government. Something else that's really important to know is that what the tax rules look like, and especially what those tax rules look like at the state and local levels, are decided by legislators. And legislators still end up being overwhelmingly not representative of the population, but tend to be more likely to be white and might not necessarily take into account the fact that certain policies and certain tax policies do have these disproportionate effects on different parts of the population. And so what are we trying to do, right? And so what we're doing with our interactive is a first step to helping people, especially people who think about taxes, think about, even though we don't have information about who is paying what taxes and by their racial makeup, those kinds of questions do come into these kinds of conversations. And ideally what we would like to do is we'd like to think about, and what we're working on right now, is thinking about the more complicated question, and what are the tax burdens that different people, based on their racial characteristics or their income, pay in taxes. There are other groups like CBPP and ITEP who are also doing work on this and are trying to think about how tax policy affects different groups and how parts of tax policy could benefit or either close or exacerbate differences in income and wealth across different populations. And so we're trying to think about these questions now. These questions become even more important as we think about the fact that we're spending a lot of money in response to the current pandemic, and it might lead to it's an opportunity to try and close some of these gaps, but it could also exacerbate differences across groups. And so as we move forward, being mindful about what these differences are and what they might look like are important. And as Arvind said before, we have a link here to the feature and to a blog where we talk about some of these interactions. And we're also happy to get emails or contacts from you, both talking to us about what we're doing in this feature and also any suggestions you have about what you think are important questions to look at and what we should be doing next. Thank you for letting a couple of economists crash your party. And now I'm going to pass it over to Jeremy, and it'll become much more about what's going on the legal side.
Thank you, Kim. That was really fantastic. And I have to say thank you to all the participants again. It's just wonderful to see the extent of the interest amongst the tax community in this issue of racial inequality, and I'm very grateful to have your participation. So my name, as Omeed had mentioned, is Jeremy Barafran. I'm an associate professor of law at George Washington University Law School. Prior to GW, I also taught tax at NYU School of Law for 2 years, and prior to that, I was tax counsel to Senator Elizabeth Warren. At GW, I teach our one section of our federal income tax class. I also teach a tax-exempt organization class and a tax policy seminar. Today, I'm going to be sharing with you my findings in an article titled, "Should the IRS Know Your Race? The Challenge of Colorblind Tax Data." And the focus of that article is on the omission of race and ethnicity in both the collection of federal tax data and the analysis of federal tax data. So Kim and Arvind have done a fantastic job in pointing out various disparities in our tax laws, and as they mentioned, other tax scholars like Dorothy Brown and Karen Brown have also done work trying to identify those disparities. What my research looked at was the extent to which our federal tax data institutions, these are the organizations that are funded by the public and directed by Congress to analyze our tax policies, the extent to which those data institutions omit race and ethnicity. And I'll go through that historically over 100 years in a number of various publications. So this story begins with Form 1040, and I've shown here the original Form 1040. I think tax nerds will be excited to learn, for those who are unfamiliar, that the form has always been called Form 1040, even since its first incarnation in 1913. I was able to access that through Joe Thorndyke's Tax History Project, published by Tax Analysts. That form is on the left here, and on the right you see a recent Form 1040. This is from 2017, pre-TCJA, but they all share the same feature across 100 years, and it's still true today, that Form 1040 does not ask taxpayers to identify their race or ethnicity. Separate question about whether we would want the form to ask that question. I'll begin simply with the descriptive claim here that the form does not ask. And this is actually somewhat exceptional relative to other areas of public policy. So I've included here the Social Security application form, and you'll see it includes a question about race and a question about ethnicity. And Social Security Administration actually asked this question since the beginning of the program in 1936. So for almost 100 years now, Social Security has been asking for race or ethnicity when signing individuals up. This is also the case with housing policy. Here's a form from HUD asking individuals who are tenants in public housing to provide information on their race and ethnicity. And this is true in public education. So for those of you who live in Washington, D.C., I've pulled our D.C. public school enrollment form, but this is true across school districts in the country. And our federal and local institutions ask these questions often because they're required to do so by law. The Civil Rights Act of 1964 and subsequent laws require public institutions to fulfill certain standards of non-discrimination. And were a school district, for example, not to document the race and ethnicity of its students, it wouldn't be able to report things like high school graduation rates and whether or not there might be disparate outcomes by racial groups. Now, we know in education, unfortunately, for generations, we do see disparate outcomes, and that's also true across federal public policy areas, including housing and education. So our tax form doesn't ask about race or ethnicity. Generally, public forms actually do ask, but the story doesn't end there because even if our forms did not ask about race or ethnicity, there are other ways that federal tax data could include demographic information even without it being initially asked on the form. And so here I've pulled for you an excerpt from a Statistics of Income publication in 1936, looking at tax return data from 1934, and it provides some basic raw numbers about taxpayers by gender. So it's showing to you the number of returns received in a tax year, tax year 34, by single women, number of returns received by single men, or a number of returns filed. And it's not making any inferences about discrimination or disparate outcomes. It's simply providing descriptive statistics about the population of filers. Our tax return in 1934 did not ask about gender. This is also a question that does not appear on the form, and yet our Statistics of Income Division decided it was relevant to the public to include that demographic information. So they did something called matching, and this is work that economists have developed and statisticians for decades, where even if one tax data set does not include a certain piece of demographic information, another data set might. So, for example, Social Security Administration has race and ethnicity data. They also have gender data. Tax data is already matched with Social Security Administration data through with payroll withholding. And for a number of years, that would have been an easy option to include demographic information in at least the public de-identified statistical publications but that was not the case. And so what I show in my article, Should the IRS Know Your Race? The Challenge of Colorblind Tax Data, is that our three primary tax data institutions have not included race or ethnicity in their analysis of published tax data. These are analyses that are de-identified, so taxpayer information is, of course, confidential, but they regularly publish things like the annual IRS Data Book, the JCT Blue Book, the President's Green Book. These are publications from the Statistics of Income Division at the IRS, the Joint Committee on Taxation in Congress, and the Office of Tax Analysis at Treasury. And I looked at their publications across 100 years, and for those of you who go to the free download of this article, you can see this table as well in additional detail. And the practice was uniform across presidential administrations, across various staff within the offices and different policy priorities and historical periods. All of these federal tax data institutions had the same result, which was to not include race or ethnicity in their aggregate statistics about tax. This has some substantial consequences. One, our federal tax data institutions are directly involved in the tax policy-making process and in tax administration. So, for example, Office of Tax Analysis at Treasury will advise the IRS on the development of tax forms. The IRS Statistics of Income Division will work with the IRS Commissioner on new approaches to auditing or design of regulations. Joint Committee on Taxation advises Congress on every piece of tax legislation that is proposed and discussed in hearings, and then ultimately those bills that are passed. And when I was a tax counsel in the Senate, I leaned very heavily on Joint Committee on Taxation staff, and I still remain deeply grateful for their expertise in helping design and refine our tax laws. As a resource, they are invaluable, and yet their publications do not include race or ethnicity. So when a senator is trying to decide whether to reform the mortgage interest deduction, for example, that information typically is not given in either the public or even private accounts of the impact of that reform. So there are three primary areas where I see colorblind tax data creating issues. So the first is in tax expenditures, and we heard some great details here from Kim and Arvin, and I won't spend too much time. But as you know, our tax code is actually one of the most powerful tools that we rely on for our social safety net. And so this is true for housing benefits, retirement benefits, education benefits. And because of the practice of omitting race and ethnicity from both the collection and analysis of federal tax data by our federal tax data institutions, we do not have clarity about how the burdens and benefits of our tax code are distributed across different racial groups. And so here I provided one example of some findings by Beverly Moran and Dorothy Brown about mortgage interest deduction and who is benefiting from that tax expenditure. There are also some surprising ways that some might not have expected to see different outcomes by race. And here I've pulled a finding by Emily Satterthwaite at University of Toronto about different S-Corp election rates that vary by race or ethnicity. Black entrepreneurs are less likely to claim an S-Corp election than white entrepreneurs or owners of entities that could be eligible for claiming S-Corp status. That's something that our federal tax data is not showing us, and it required Emily Satterthwaite's independent survey research working with Kaufman firm survey to identify. And this is connected to the revenue-raising role of our tax code, separate from the safety net role. And then lastly, the Internal Revenue Service is involved in tax enforcement. The most common form of this, of course, is audit. But IRS Chief Counsel's Office, as you all know, as members of the tax bar, are working with taxpayers regularly in many different ways, offers and compromise, for example, various settlements in the exam process. Do those outcomes vary by race or ethnicity? That's something I think the public should know. I think that's something that internally the service should be making sure is not happening. And enforcement is an area where we know painfully that law enforcement does vary by race or ethnicity, that the experience of individuals in our country who are black and brown is not the same as white individuals, and that is part of the movement for Black Lives right now. So to omit race and ethnicity in our understanding of tax enforcement potentially conceals some very worrisome possibilities and outcomes. And I'll share one additional empirical point here. We have clear evidence from the employment context that first name and last name are used as proxy for race quite often when an employer is reviewing a resume. So in a randomized controlled trial where an employer will look at both the same exact resume but with different names at the top, we see different outcomes for names that are associated with Black or Latino communities. We know on Form 1040, even if race or ethnicity are not asked, first name and last name are included. And so there are also opportunities for potential staff to either implicitly, through implicit bias, or explicitly end up making different choices based on their assumptions from those names. So even though we are not asking on the form, that doesn't mean we should assume there's no opportunity for discrimination in enforcement. I've included the link here to my full article. It's 25,000 words, much longer than what I've been able to get in our 15 minutes together. But I'd be delighted to answer any questions about the work, and I do encourage you to download here from this link. As an attorney and a scholar, I love footnotes and citations, and you can get some deeper dives here. The last point that I'd like to raise is a painful anecdote that I note in the acknowledgments for my paper. This article, Should the IRS Know Your Race? The Challenge of Colorblind Tax Data, is dedicated to Eric Gardner, an African-American man on Staten Island in New York who was murdered by the police. And when he was initially stopped by the police, he was stopped under suspicion of selling cigarettes without having paid the required stamp tax. And that's not a federal tax, that's a state or local tax. But here we are seeing an example of an individual who was not treated the same by law enforcement because of his race and ethnicity, and that was a tax enforcement action. And it raises the question to me of what other forms of potentially disparate enforcement are happening without being documented. So thank you for your participation today, and I look forward to your questions. And now I'd like to pass it on to Professor Karen Brown.
Thank you, Jeremy. And I'd also like to thank Omeed and my other participants on the panel, Omeed for organizing this, and my other presenters for presenting really deeply important and interesting work. So I'm honored to be a part of this panel. I'm proud of Omeed with the GW connection, and maybe we overdid a little bit with the GW connections, but I'm happy we're doing it today. So my slides are dealing with tax law and social justice, and I'm going to start out. That's my topic in general. My particular focus will be on an article I did on the tax treatment of employment discrimination damages. But I did want to situate this in the context of a larger movement. And so I'm starting out with Taxing America, which is an edited volume of essays published back in the late 90s by Mary Louise Fellows, who's an emeritus professor of law at University of Minnesota, and by me. And we were both on the same faculty at the time, and we were able to work together. We've been thinking about these issues for quite some time, and we're able to get together a really fantastic group of people who talked about a number of topics. So our project really was to give serious consideration to how the tax system exacerbates marketplace discrimination against traditionally subordinated groups. And so the book, or the collection of essays, really goes beyond the particular topic today, but they're all interconnected. There's a lot of intersectionality, but I'm pulling out today a particular focus on race. So we were looking at or soliciting essays and work by other scholars who were examining whether tax law reinforced subordination of persons based on their physical or mental abilities, their class, their gender, their sexual orientation, or race. And we advocated interjecting a social justice approach to examining, assessing the effectiveness of tax law. And so what we basically did in the piece, in our introduction of the various pieces, was basically to interrogate the fiction that sound tax principles really rest only upon principles of economic neutrality, objectivity, and progressivity. And so I'll say, and this may seem like an overstatement, I don't really think it is, but I think that tax law's complicity in reinforcing the effects of systemic racism is probably the biggest threat to its legitimacy. So let's, and I will come back to that theme as I go through the slides. We had 14 articles published in the book, 4 relevant to this particular session and relevant to things that have already been spoken about today, particularly the presentation of the Tax Policy Center work. So path-breaking, so wonderful. And so I just wanted to focus on, as I said, 4 of those for now, and then get into my piece that really was published after Taxing America. One was by Professor John A. Powell, who was also a University of Minnesota law professor at the time. He went on to Ohio State University. But his piece on how government tax and housing policies have racially segregated America was absolutely amazing. And he looked at how bank redlining and other federal housing policies led to basically segregated communities in the United States, all with the imprimatur of the federal law. So this segregation basically led to pocketing Black communities in areas with diminished public services, lower opportunities for economic stability, and less home equity. And his work, there was some interesting work done by Elizabeth Warren when she was also a law professor before a long time ago. She did some really important work about how, for example, even if you take a Black couple and compare them to a white couple with the same level of education, they end up being basically, in the end, not in the same economic positions because Blacks, for a number of reasons, they may be forced to buy in racially segregated communities. They don't have as much home equity. They don't have much appreciation in their property. Their interest rates are higher, so they're paying off more interest to pay off their homes. They don't have an opportunity to use their homes as a pivot or a leverage to borrow money for other purposes, for example, for education for their children, et cetera. And so her work and John's work really dovetail quite nicely. And John pointed to the diminished value of tax benefits, including the home mortgage interest deduction, as Kim and Arvind have talked about previously, there is a capital gain exclusion for sale proceeds on principal residence, having a disparate impact on Black communities. The tax-free imputed income from being able to live in your home, and also deductions for local real estate taxes. Dorothy Brown, her name has been mentioned a lot today. I'm sure her ears are burning, but she's had quite an impact in the scholarship in this particular area, and she had one on marriage bonus penalty in black and white. And here she looked at the higher rate of entry into the labor market by Black women at typically lower wage jobs, the lower wage earning by Black men compared to whites. And this is interesting. There was, I'll talk about this a little later, there was a piece in the New York Times on Sunday in the review section, which did a lot of looking at topics that are of interest, I think, to people who are in this seminar. You might want to take a look at it. This comparison of the wage earnings of Black men to white men you would think would have changed, but there is a publication there, short article by economists who kind of redone the numbers and said that actually it hasn't changed since 1968. And they showed that Black men are earning 51% of what white men are earning. So add that to everything else, there's a greater likelihood of a marriage penalty because you would have two wage earners earning roughly equivalent incomes. Black women suffer wage discrimination as Black men do. If you have a couple consisting of two spouses who are Black, then they suffer the marriage penalty and are subsidizing higher income white couples where there is one income earner, one person can go out and earn enough money to take care of the entire family, and the other is staying home. And she also referred to the income tax, the earned income tax credit, which was discussed earlier as well. There is a serious penalty at the low income range. My students and I last semester took a look, and the difference could be as much as $7,000 or $8,000 for couples who are working poor, right at the poverty level, with a lot of children ostensibly to feed. That could be a tremendous disincentive to marriage, and Dorothy talked about that. I'm mentioning Beverly Moran's piece on economic development only because Beverly Moran, I just want to say, I know Jerry mentioned her as well. Beverly Moran is like the person who actually got this movement started back in the early 90s, and she did submit a piece, an essay in Taxing America, where she looked at local incentives to attract business and showed how they were detrimental to communities of color. And this does come up again. We here in Washington, D.C. are considering the Washington NFL team is considering moving, and the question is D.C. going to subsidize a new stadium? There are a lot of issues around that, but it always ends up being that there are promises, and then the business that moves in ends up moving out eventually. So, and this is what's happening to Prince George's County, which attracted the team some years ago. And then finally, and I'll mention this again toward the end, the piece, the essay that I submitted and was included in the collection was entitled Transforming the Unilateralist into the Internationalist, New Tax Treaty Policy Toward Developing Countries. And this really looked at back in another world, right, because in 2017, the international tax system completely changed. We went from, at that time, we had a worldwide tax system with deferral, and I was looking at that particular system and noting that we had no treaties with sub-Saharan African nations except this treaty with South Africa, which was being renegotiated after the Anti-Apartheid Act. And then if you think about Latin America or South America, we had a treaty with Mexico, which we still do, but with no other, and even today with no other countries where there are significant populations of color. And so I looked at that system and the fact that those countries basically in that regime and setup had no ability to use their laws to attract investment. And I advocated regional treaties, which would provide protections for the locality trying to attract investment from U.S. businesses such as environmental protections, infrastructure guarantees, gender equity issues, et cetera. And I'll come back to that. So let me talk a little bit about the employment discrimination piece. As all of you tax people know, the 104A2 was altered in the end of 1996 to switch from an exclusion for damages received on account of a personal injury to wording which allowed an exclusion for damages other than punitive received on account of a personal physical injury or physical sickness. And this did coincide with some Supreme Court decisions that came out at the time, which were interpreting the old version of 104A2 not to include an exclusion for employment discrimination damages or age discrimination claims, gender-based and age-based employment discrimination claims. There were scholarly views, and still are, of old Section 104A2. The pre-amendment version was viewed as a departure from the ideal base, or even if it was, there's a policy justification for excluding damages from physical injury, but not to expand the exclusion to include employment discrimination damages. And yet a third approach, which is an approach I took in this article, which was published in 1998 in the USC Review of Law and Women's Studies, which was that it would further society's anti-discrimination goals by acknowledging the harm of job bias and reflect a better measurement of income for workers if those damages were also allowed to be excluded. So there's a dichotomy set up with the new language in 104A2. Any damages arising on account of a physical injury are excluded, and that would include lost wages, pain and suffering, emotional distress, even third-party claims for loss of consortium, whereas with non-physical injury, no exclusion unless there are emotional distress damages, which can be substantiated by medical expenses. So in effect, it's giving you a deduction for your medical expenses without the 10% adjusted gross income limitation. In the piece I mentioned, I take the position that the codification does support the notion that physical injuries are real, tangible, legally perceptible, but employment discrimination is not real, it's imaginary and not traceable to a cause. Looking at the rationales for the amendment, I couldn't find any justification, not on the basis of magnitude of harm to the taxpayer, not on the basis of revenue maximization. For example, Congress wanted to limit the revenue loss for the exclusion because, as I mentioned, the exclusion for wages remained, and wages are normally taxable. Third-party claims remained as well. And you couldn't justify it on the basis of fraudulent claim reduction, for example, because are we to say that employment discrimination claimants are less trustworthy than physical injury claimants? And then finally, I looked at this notion that perhaps the limitation was because the employment discrimination claims are basically to serve a public function of punishing the employer who has to pay damages. The fact that there are recoveries is really to punish the employer and doesn't address the harm to employees if you want to make that argument. And that argument could be made based on the types of remedies that were available. But that I have to reject as well because the deduction for employer payments to discriminated workers were not, those deductions were not limited. And then I'm noting now in the 2017 Act, the only limitation that now is on those deductions is that if they are the subject of a non-disclosure agreement, then the damages and attorney fees are not going to be deductible. And so that seems like a really minor limitation or a tweak on that, but not acknowledging the basically the subordination that arises from not allowing the exclusion for employment discrimination. Also looked at, basically the piece looked at how the failure to exclude the employment discrimination damages devalues worker production costs. It ignores their costs of working in a job where they're discriminated against, and denies an offset for the costs of working in a discriminatory marketplace. Cost of earning income really is a proper measure of income. I know that there are lots of limitations, Section 67, et cetera, in place right now, but if you're looking at the rationale for measuring income, the cost of earning income should be an offset. So if we would allow the exclusion of the employment discrimination damage, this would be to allow such an offset. Giving also credit, or at least paying homage to the strong anti-discrimination policies in society and in the law, allowing the employer a deduction but not the employee an exclusion, does seem to be a reward for discrimination. I mentioned also that employees are undertaxed, employers are overtaxed, employees are undertaxed. Employees are overtaxed, employers are undertaxed. If you want to pursue this, there's an excellent piece by Mary Louise Fellows and Lily Kong that looks at this a little bit more broadly. So wrapping this up a little bit, and to come back to the beginning, which is I wanted to place this in the context of a social justice critique of the Internal Revenue Code, not the service. Believe me, I love the service and think they're doing amazing work considering that they have very little resources. But a social justice critique of the Internal Revenue Code, is there a future here? And so I noticed that tax law has been very slow to respond to critiques. The 2017 Act, there were no changes with respect to the tax benefits of home ownership that are at all responsive to any of the critiques that have been out there. I would say that even if you recall, President George W. Bush set up a commission that suggested that we might go to a housing credit as opposed to the home mortgage interest deduction, which would make that benefit a little bit more fair, but that didn't come into it. And the changes that were made did still allow deduction for two homes. There's a limitation on the cap, at least for now, but still you can deduct interest on two homes. But as Kim mentioned earlier, no incentives for example, subsidizing first-time buyers. I mentioned also the international tax regime coming back to the changes in the international tax regime, coming back to the piece in Taxing America. So we did go to a new partial territorial system, but again, I think we missed opportunities to address systemic racism. The new Section 965 allowed repatriation of trillions of dollars that have been held offshore. They've come back at vastly reduced rates, although there's been deferral on that income for decades, and no payment at the 35% rate, but as I said, much lower rates depending on the type of earnings that are brought back. And I thought there was a missed opportunity here to allow the lower rates for the earnings that were deemed to be repatriated, but requires some investment in Sub-Saharan Africa or any other area of need that we know about. No incentives for tax treaties with developing countries. As I said, the treaty situation hasn't changed. And I'll notice that there's a parallel initiative, the OECD and the BEPS project, which is basically completely reimagining international tax law. Even at the beginning of that initiative, when developing countries asked basically for a seat at the table to kind of determine where international taxation was going, for example, are we going to take an international approach or a separate country approach, which we ended up taking, and developing countries asked for this whole thing to be put into the UN, the OECD members said, well, the OECD is already looking at it, and by the way, we're not going to take that international approach, and so you're just going to have to go along with us. So nothing much has changed there either. I'll just mention a couple of other things. The child credit, for example, being expanded to be available for couples with AGIs of up to $400,000. The New York Times had a piece sort of exposing this and showing that the people really needed the credit were not getting it because of the limitations on their refundability credit. And then Francine Lippman has done some work on the change to the credit, which basically was aimed at denying the full value of the credit to basically that's going to impact heavily on the Latino community. The anti-subordination analysis continues in scholarship. You've just heard from Jeremy Barra-Friend, Dorothy Brown, Anthony Infante, and Bridget Crawford, Francine Lippman, Beverly Moran, Lily Kong, Mary Lou Fellows, Phyllis Tate at FAMU, and others are doing the work, but much has not changed. So I did want to mention a couple of developments. Other scholars are taking a look at the social justice aspects of the tax system, and I wanted to mention the wealth tax proposal that was just written about in the New York Times, again, in that special section I talked about it last Sunday. Lily Batchelder talks about, of NYU, gives a wealth tax proposal. And there's a subtitle of the Silver Spoon Tax, which I thought was interesting, but her article is really entitled How to Tax the Rich and Their Heirs More Fairly. And she basically notes going to an inheritance tax or a stronger estate tax as being more equitable, noting that wealth holding of blacks is only 9% of that of whites. Notes that this wealth is key to financial security, based on the work of Elizabeth Warren and John Powell and others. White households are twice as likely as black to receive an inheritance. Receiving an inheritance is associated with an increase in wealth that is 26 times as large for white families as for blacks. And 40% of all household growth stems from inheritances. So she looks at the high estate tax exemption that we currently have, about $23 million for a couple. And she shows that this basically amounts to an effective tax rate of 21%. She gives an example of a $50 million inheritance. She notes an imminent transfer of about $84 trillion in wealth from baby boomers to the next generation, and says that this is an appropriate time to think about disrupting these forces that are working to basically sustain inequality. And she does recommend a higher estate tax, a reduced exemption, possibly an inheritance tax that recipients of the inheritance would have to pay income and payroll taxes, and then tax on built-up gain in assets that are transferred by death as possible solutions. My last remarks basically is, well, what can we do? As I said, we don't really see any change in the tax law. Maybe some social justice mindfulness and congressional reports, which, based on Jeremy's work, if we could get that information, that could definitely happen. One thing I did want to mention is the World Bank has set up a project in conjunction with the OECD Development Center. And basically, they're looking at a human-centered business model and suggesting that governments around the world, including the United States, basically start thinking about how they can use the tax laws, environmental law. There are 5 areas, basically, of law in which they're making suggestions that we might want to think about the UN Sustainable Development Goals for 2030, which include a racial and gender equity component, and that we might think about rethinking and sort of tailoring our tax reform and reform of other laws in that direction. So that's an encouragement. If anybody picks up on that, that would be great. So I'm going to go ahead and conclude. Thank you very much for listening.
All right. Thank you so much, everybody. It's such an honor to have these panelists here with us today. And so now we're going to move on to the Q&A section. We've been taking questions here from our live audience. Feel free to submit your questions via the Q&A feature on the webinar interface. So I'm going to start us off with a question that we got regarding federal tax incentives. So we have a question: how would federal tax incentives for economic investment in economically disadvantaged areas through new markets, tax credits, and the Opportunity Zone program be characterized from a racial impact perspective? I believe that Kim is going to be answering that question at first.
And so I would say that it's a great question. I feel like in some ways you would need to look at who's actually benefiting from it. There is a level where we're a little concerned that these programs, while in theory are supposed to help specific areas, might actually be set up in such a way that they're mainly acting as a shift of benefits to the investors. And so I think a lot of the questions we're thinking about and depend on how you measure what we mean by who's benefiting in some ways. So I feel like a lot of the people who are physically getting the benefit are going to probably largely be investors who tend to be more likely to be white than not. But if they're actually set up, and depending on how the programs and the areas are chosen, it could benefit communities where you might see a broader set of benefits to a broader set of the community. But again, a lot of this depends on which programs and which projects end up getting the benefit, and whether these are benefits and whether there are projects that wouldn't have been done. Our fear at TPC is it looks like a lot of what's going on in the opportunity zones are people just reclassifying things. So the people who are largely benefiting from a lot of these things are the investors, not necessarily the people on the ground.
So another question we have relates to the increased standard deduction in the Tax Cuts and Jobs Act. The question is, doesn't the new increased standard deduction remove a lot of benefit to homeowners and in turn then benefit lower income Black and Hispanic taxpayers? I believe that Aravind is going to take that question at first.
Thank you, Omeed. I can try answering that question. Kim, feel free to jump in after. So yes, indeed, TCJA, the Tax Cuts and Jobs Act in 2017, did significantly expand the standard deduction and significantly limit itemized deductions, and that is true for the mortgage interest deduction as well, and for the state and local taxes deduction, which primarily benefit high-income households. So yes, the increase in standard deduction did help low-income taxpayers more. The thing is, since the itemized deductions like the mortgage interest deduction still exist, it only pushes further the uptake of that deduction towards high-income households. So it continues to cost about $70 billion a year for the federal government, and it still continues to benefit high-income households. So if the stated purpose is to increase home ownership for those who don't own their homes right now, that deduction doesn't serve that purpose as it exists right now.
See, what I would add is there is the interesting part that the fact that we're at a point where only 10% of people are itemizing means that you could imagine the federal government or Congress rethinking how we put in the incentives that we have in. We've seen this a little bit where under part of the CARES Act, we saw like there be a credit for some charitable giving as an incentive to get some people to give. That's another place where the fact that people aren't itemizing, there's some fear that we might see less money for nonprofits. You could imagine rethinking what the credits look like and what the itemized deductions look like and moving things in a way that could either benefit a broader set of people by taking it away from an itemized deduction and making it into a credit or limiting it in some way. There's a paper that a colleague of ours, Frank Sammartino, wrote that looks specifically at the SALT limit. So the fact that right now there's a $10,000 limit on the state and local tax deduction. And this also gets back to this question of incidence. So if we look at sort of who's benefiting from that deduction, it's largely higher income people. But the people who are actually hurt by the fact that there's that $10,000 limit in place tend to be people in bluer states. And if you think that those state and local taxes that they're trying to itemize and deduct could actually be used to provide spending and services in places that are more redistributive, that could help. And so there are these two sides to it in terms of what are we spending the money on, who gets the benefit from the tax break, but what is the actual policy and the behavior we're trying to encourage, and why was that incentive put in place in the first place?
So the next question I want to ask is one that is near and dear to my heart as an attorney at an LITC, and that relates to disparities among those who get tax advice, particularly with regard to tax preparers who often can prey on low-income people. We know that there's a lot of tax preparer misconduct like that goes on. And so I've opened this question up actually to all the panelists to discuss what their thoughts are on that and what data and research there is out there that demonstrate the disparities and who receives good, sound tax advice.
Omeed, I'll just mention, this is Karen, I'll just mention anecdotally, because I have not done any research on this, but I think the question is very well taken. And I'm just saying anecdotally because I'm just looking at staff members at GW who have very simple tax situations, but end up going to a tax return preparer who's going to charge them $300, $400 to prepare the tax return. And it's just completely outlandish. I mean, thank goodness we have VITA, and the IRS has been working to set up to work with VITA and have the VITA projects. And of course, people can prepare their tax return online, but it's just so complicated. I think we definitely need more resources in that area.
And I would just, and this isn't based on research, this is Kim. Right, I've been volunteering with VITA for the last, I guess it was 15 years, Meg said. And it does feel like there are certain communities, especially, and this is based on DC and the DC area, but it definitely feels like there are places that are preying on low-income households, and especially households of color, so Blacks and Latinos, especially immigrants, where they're getting bad advice, and some of this is avoidable if they could go to a VITA site or if there were more services available. And I'll leave that, and Jeremy, you could talk.
Thank you, and it is a great question and such an important policy problem. The two comments I'd like to make, first in working with Senator Elizabeth Warren on her report titled Tax Maze, which looks into all the difficulties related to tax filing and calls for various public options for filing, like a free online platform that wouldn't require using private companies to file one's taxes. In that report, Senator Warren cites a study that shows very opaque pricing in the tax prep industry, and through surveys, documents, two tax preparers in the same neighborhood, even in adjacent buildings, charging very different prices, and that tends to imply there's some other market failures going on and likely predatory activity. So that was used as further support for what was then introduced as the Tax Filing Simplification Act. So if you're interested in some policy solutions here as well, the Tax Filing Simplification Act has been introduced a few times, and it builds off of Joe Bankman's innovation of Ready Return in California, where many individuals might not even have to fill out a return, or at least would have their return pre-filled with the information the IRS already has.
So the next question I want to take from the audience is, what is the justification that the service provides, or what is the justification out there for auditing EITC recipients versus lack of auditing for higher income individuals? Is this something that exists because of certain specified reasons that the service has laid out? What are the justifications that are given for that approach, basically? And anyone obviously can take it.
I can start, and then someone else can jump in with more information. So we've been working a little bit more with the IRS administration and compliance data in recent months, and the 2019 data book released recently as well. So we have a clearer picture of the long-term trends. And the first thing to mention here is that the highest income tax returns, highest income corporation returns are still audited at higher rates than EITC returns overall. It's just that over time, the audit rates for the highest income tax returns or highest corporate tax returns have declined faster, steeper than it has for EITC returns. And this topic has gained a lot of traction recently from organizations like ProPublica Investigating, as well as a letter from Senator Ron Wyden talking about these issues. And one of the justifications given was limited resources for the IRS to allocate towards auditing complex or high income or high net worth tax returns as the justification for not auditing those at higher rates than they do already.
Okay, so then the next question I want to ask relates to EITC as well, actually, and that has to do with the fact that we know that there are lots of folks who are eligible for the EITC, but they don't claim it. We have here in Philadelphia public awareness campaigns that the city runs actually to encourage people to file returns so that they can get this credit. Do you all have any estimate of how much unclaimed earned income tax credit benefit there is? And in addition to that, do we know the makeup, the demographic makeup of those who have not claimed the EITC but were eligible to do so?
This is Kim. So this is actually pretty complicated. I've seen some numbers up at 20 or 25% about how many people might not be claiming it. And in some cases, I'm not sure whether part of it is that they're not filing taxes because they're nervous about interacting with the government, or whether they are not claiming it. And while we think they might be eligible, it might be that somebody else in their household might be claiming the kids. There is definitely the case that I feel for some people, they might not know, because if it's, say, someone who just had a baby, and they might not feel like, they might not have the information. But I think in general, communities understand about the EITC. And I feel like in some cases, people might be nervous because there is this audit rate and there is this penalty that if you're actually, if you're found to have been, to take it and you aren't eligible for it, you can actually be kept from getting it in the future. So I think there's some fear of what it means to interact and what if you're audited. Some of it might be based on complicated family structures where somebody else might be getting the EITC. And then I feel like there are definitely fewer people who are immigrants who might be claiming it even if they are eligible for it. So suppose you're somebody who has an immigrant or somebody who's here on a visa in your household, even if they're not on your tax system. People, I feel like, are more reluctant in those cases to do it because there is this increased question about whether you are a public charge or whether you're going to actually be dependent on the government. And so I feel like getting more information out there and letting people know and simplifying how you could do taxes would increase the take-up rate. But I also think that there are other things going on that make it a little more complicated.
So the next question from the audience that I'm going to ask is, Kim and Aravind specifically, are you or others at the Tax Policy Center planning to create a similar 1040 tool for gender disparities?
We're hoping to. We're hoping to do it this year, and then everything happened, and we put it on hold for the moment. But there are all sorts of super interesting questions related to gender and also related to gender and race. Like if you think about who the primary and secondary earners are and what the relevant or relative marginal tax rate would be for different people, those are also really interesting questions, and they also interact with race. And so we're hoping to do something very similar. We were originally hoping to do it this summer, but that's not happening. So now I think we're hoping to get something done over the span of next year to put something up where we're doing something similar by gender. But there are interesting questions to address, and it's also interesting to think about the interaction of gender and race, especially.
So the next question that I'll ask is, do any panelists know of or anticipate any litigation against IRS administration or with regard to the Internal Revenue Code as of the IRC being racially discriminatory or otherwise unfair?
This is Jeremy. I think that's a great question, and I will say it's a largely understudied area. In doing my research on colorblind tax data, I would get a number of questions about, well, okay, if we had this data, what would we then do with it? And frankly, tax lawyers tend not to be non-discrimination law lawyers, and being able to figure out what would be actionable is difficult. We know in the courts, discriminatory spending through tax expenditures rather than direct spending, there are different claims that can be made. And I think there could be other challenges within potential disparate enforcement and impact of our tax code. One lawsuit I am familiar with is related to the exclusion of certain children from CARES Act provisions. I believe children of immigrants were discriminated against, and there is a class action that's moving forward with Les Book helping advise, and I think it's a Georgetown clinic that is running that.
So the next question, we have time for a couple more questions here. What are some of the risks or concerns that are associated with collecting data on taxpayers' races and ethnicities? Are there concerns that could discourage filing or could implicate privacy issues, or concerns about how that data could be used politically? So I wanted to get an answer to that question. I think Jeremy could probably speak to that at first.
Yes, I'm delighted to, and I think that is a really important question. And a few points that should be raised. The first I would say is that simply because our federal tax data institutions are not including race and ethnicity in their published analysis, I don't think we can look at that and presume it means tax policy is not racially motivated. I think we have many reasons to believe that race is actually already happening as a factor in the minds of policymakers and in the minds of voters. And even if our tax data institutions are not including that information. And so I'm not worried that just because our institutions then start acknowledging race or racism, they actually make our society more divisive. And in fact, right now, by not including race and ethnicity in their publications, they're simply concealing what might be going on. And one powerful example of that I'll point to that many of you will be familiar with is our history of poll taxes in the United States. This is when local governments would keep black voters from actually being able to vote using the tax code. When you look at the actual statutes for those poll taxes, they make no mention of race or ethnicity. There is nothing in those statutes that says poll taxes shall only be applied to black voters. Yet the intent behind those laws was to limit black voting, and the enforcement of those laws did limit black voting, and it required a new constitutional amendment to prevent. So I think that's a powerful example of just because it's not in the statute and just because it's not documented in the data doesn't mean we shouldn't be reporting on it. And in fact, by not reporting on it, it makes it much more difficult to address.
So I think we have time for one more question, and it's a question on a timely topic having to do with the economic impact payments or stimulus payments that have been authorized in the CARES Act. And this question relates to the fact that the IRS has said that incarcerated individuals need to return their EIPs, and that they should return such payments. There's been a lot of controversy about this, of course, and so the question here is, what is the racial impact of this policy of having incarcerated individuals have to return these payments? And generally, if panelists can discuss about this, we have about a minute here, but quickly, if we can get an answer on this, it would be great.
I can answer, right. I think just if we think about the disproportionate numbers of, especially African Americans who are incarcerated, it would have to be that they are negatively affected by that, right? I think that a lot of the things that are limiting those payments have made them less beneficial for families and individuals of color. If you also think about the way that the payments are set up and the fact that it was easier for people who had bank accounts listed on their prior returns to get those payments automatically versus needing it to be sent there, that also is going to make it them less useful, and they will receive less quickly by individuals of color.
Okay, so that's all the time we have. Thank you so much to my panelists here today. Before we leave, I will ask attendees who want CLE credit to stay connected for instructions to get your CLE certificate. Also, please wait for the evaluation to come up on your screen. To our faculty for this program, again, thank you so much for sharing your expertise with us. On behalf of the American Bar Association, I'm Omeed Firouzi. Thank you all for joining us, and I will now turn you over to our operator for some additional information.
Thank you. On behalf of the American Bar Association and the ABA section of Taxation, thank you for participating in this program. To learn more about the sponsors, visit the ABA website at americanbar.org. Thank you, and please click on the evaluation link that is now appearing. I'm just going to get this set up. Here we are. So it should now be appearing shortly on your webpage. For those of you who want CLE credit, please click on the link that's now appearing in the presentation window. This will open the program evaluation. After you submit the evaluation, the attendance confirmation form and request for CLE credit will appear. Please complete the information requested on the form and submit. Your information will be verified, and if your attendance meets all the requirements for CLE credits, then your certificates will be emailed to you. Thank you once again, and have a great day.